All right, where were we? Holy cow. So every tab I usually get, this is going to go on all day now because every tab I usually click on is now gone. And it's all from scratch, but that's okay. That's all right. I like a challenge. All right, kids. So we were looking, oh, I'm sorry, you didn't see any of this stuff. So let's very quickly go back. We are talking about the earnings so far. And we have our lovely little infographics that we're able to spit out now very easily. So 11.9% growth, 75% beat rate, 13.2% profit margins, all good, good, good. The key thing here, though, is everything's priced to perfection. You heard me yabbering on about that. And really, that's all I was doing, was staring at this and talking, so you didn't miss anything. So the bottom line is, look, you always have to think about it that way. It's your interest rate. When you take the PE ratio, and when the PE is 20, it means it takes 20 years for you to get your money back. So therefore, you're getting 5% a year back. If it's 40, you're getting 2.5% a year back. If it's 100, it takes 100 years for you to get your money back. If it's Tesla, it takes you 200 years to get your money back if all the bullshit he says actually happens. If not, maybe 1,000 years, maybe forever, you know, whatever. So, and that's why when in chat, people ask me about, like, how about this stock with a PE of 100? How about this thing that never made any money? It's like, no, thank you. I don't want that. And look, if you want to make money, what is PhilStockWorld's mission and statement, right? It's be the house, not the gambler. And what does that mean? It means we're not the ones playing the risky stocks. We are the casino. And by the way, when you're in a casino, they don't have games that pay you 100 to 1. Well, I'm sorry, they do. They have, you know, weird bets, but the bets where they pay you these weird amounts of money, like if you get a royal flush on a thing, you know, you get this thing. That's because the chance of getting a royal flush is astronomically bad. And what they pay you is, well, essentially what they pay you is nothing because it's out of a prize pool. So I'm not going to do the math. It's too much of a waste of time. Anyway, take my word for it. So, in other words, when they have the big prizes, like you win a car if you do this, or even a slot, even a slot machine, they have these big payoffs. But the big payoffs, the chance of hitting it, which is like the lottery, the chance of getting $1 billion is 2 to 3 billion to 1. So even though somebody might get $1 billion, that's out of $3 billion that was placed in bets, and they paid off $1 billion, and that makes everybody want to do it because they paid somebody $1 billion, but they made $2 billion because they already took the bets. That's what it is when you play a stock that has 100 to 1 PE. It might explode higher. You might get your money back. And by the way, having 100 to 1 PE doesn't mean it's got a chance of winning. It just means it has a ridiculous PE. But those kinds of stocks, those startups and momentum stocks and things like that, that people think are going to go up 10 times or whatever in the next few years, it's a gamble. If it wasn't a gamble, everybody would be a billionaire. It's a gamble. So you get sucked into playing these things, and they're not good odds. And when you're in a casino, like I said, the games that they give you, that they let you play, are all in the house's favor. They don't let you play games that aren't in the house's favor. Those games aren't there. The casino, that's why every casino you go to has blackjack and roulette and craps and slot machines and whatever. They all have the same games. You know why? They reliably play the same amount. They reliably pay a certain percentage to the house. And over time, it's a virtual statistical certainty that they're going to win. And they're not going to win a lot, but they're going to win consistently all the time. And that makes them incredibly wealthy. Whereas the guy betting money, I'm sure I've said this before, but I'll say it again. Roulette. Let's see. Hang on. Roulette wheel. Okay, well, that's a better way to look at it. If anything is working, why is it not doing anything? Yawn. There we go. Okay. So roulette has 36 numbers, right? And what do they pay? They pay you 35 to 1. They should pay you 36 to 1, but they don't. They pay 35 to 1. There's one extra number. That means that you are getting ripped off by 3%. Because when a 1 out of 36% chance hits and you get paid 35 to 1 instead of 36 to 1, you're getting paid 3%, 1 out of 35, a little less than 3%, but you're getting paid 3% less than you should be. That's them flat out stealing the money. Look at these numbers. See this column? 1/3 of the numbers will pay you 2 to 1 if you get it right. Doesn't pay you 3 to 1, it pays you 2 to 1. Those are not good odds. The same thing with red and black. Red pays even. I mean, there's 36 numbers and you get red and black. But you know what? There's not 36 numbers. There's 37, 38 numbers. There's 38 numbers and you're only getting paid, and 2 of them are not red or black. And you know what? That means you're getting screwed by 6% on the red and black bet. Every time. So if you play 15 times red and black, you have a good chance of losing all your money. Because the statistics of 6% against you will catch up. It will eventually be 0-0. Also, obviously, since these are also not being counted in the 35 to 1, you're actually getting, it's not 3%, it's 9% against you when you get paid. So every time you get paid, you're getting paid 9% less than you should be. That 9% is not, even though you don't feel like it, because you just won 35 chips, right? You put 1 chip down, you win 35 chips, you feel like fantastic. You should have gotten 38 chips. And every time you win, you're getting ripped off by 9%. And that means that even if you're doing well, and even if you're winning on a pretty good clip, you're still going to get your cash pile eaten away by the odds being against you. And it's the same thing with these things. I think these pay 3 to 1. These 12s pay 3 to 1. But again, you got 2 other numbers that aren't being counted, and therefore you're getting ripped off by 6%. So in roulette, it's really a question of how badly do you want to get ripped off. These that pay 2 to 1, these are insane because you're getting paid 1/3 less than you should. 1/3 less than you should means you are going to be broke as fast as possible doing this. Here, you're only getting ripped off by 6%. Here in the field, you're getting ripped off by 9%. So, and like I said, here you're 6% ripped off. Here you're 30% ripped off. You're always getting ripped off. But that's how they build these gigantic casinos. That's how they make billions and billions of dollars. That's why Steve Wynn, he seems like a nutball when he started building the Wynn Casino, and it was going to be like a multi-billion-dollar project, and everybody's like, holy shit, what happened? He opened that casino up, and within 6 months he starts building the Encore next to it, because he's like, I could build 3 more of these and still make money. He proved his model. He proved that people will go and stay in these opulent, ridiculous places, and he can generate enough money on the floor because most people, almost everybody, including you guys, because how many of you guys know that you're getting ripped off by 3% every time you win? It's normal. It's a normal thing. You don't think that way in life. And the great thing about options is you get to be the house. You get to sit on there's no friction. Like if you, on craps, you can be the house in craps. You can go on the other side of the table in craps and bet against the players, but the odds are just as against you as it is to the players. Because of all the little bullshit things that they do where they don't pay you correctly. But in options, when you're selling them, you're not getting ripped off. When you sell options, you have the exact same ability as a broker has selling. You have that house advantage completely in your favor. All those calculations are in your favor. They don't change the calculations. So you're taking the spread. You become essentially the bookie. Now, what's the upshot of that? The upshot of that is we would be insane to play random games. Ocean's 11, the whole plot to Ocean's 11, I think it was the original Ocean's 11, is that they tricked the casino guy into putting into his casino a new game. And the new game allowed the criminals or whatever, I don't know who, the good guys, the good guy criminals anyway, whatever you want to call them. But it allowed, George Clooney and his pals to rig the game and cause chaos in the casino. But this is why you don't introduce new games in the casino, or they do once in a while, but they're very, very hard to get a casino to accept a new game. They have to test them and test them and test them and make sure they run and blah, blah, blah. They're never going to jump and say, oh, put that on my floor. That's never going to happen. They want to see that thing run for 100 years. They want to simulate 100 years worth of running and make sure that they have ironclad returns. So blackjack, roulette, craps, slot machines, these are the games that are in a casino. And these are the games we play in our casino. We play steady blue chip dividend stocks with long earnings histories and low PE ratios that do pay you your money back over time. Are they perfect? No. The same way it's not perfect in roulette. Some guy could bet 35 and hit 35, and then he can take all the money and put it on 20, and then he can take all that money and put it on 8, and they can all hit one after the other. It happens. That's part of statistics. Losing is part of statistics. But over the long haul, given all the people who play and all the times they play, the statistics turn back in your favor. But only if you continue to play the game and not if you quit as soon as you take a loss. You have to have faith in the numbers. And I don't mean faith like a religious faith. I mean a mathematical, scientific faith that works. Except, and by the way, this is also important about a casino. Why do they have limits? They have limits because if Bill Gates comes in and bets $100 million on 35 and he hits it, then he's going to get $3.5 billion. Is that right? Whatever. Anyway, lots of money. And the casino doesn't have $3.5 billion to give him. That's why there's a limit on the game. And the limits they place on the game are to make sure nobody does an infinite doubling down strategy. That I forget the name of it, I think Monte Carlo or something like that. But if you lose, let's say you bet red. I bet $10 on red and I lose, and I bet 20 on red, and then I bet 40 on red, and I bet 80 on red, and I bet 160 and 320 and 640 and 1200 and 2400 and 2400 and 4800, and now I've already bet 1,000. Now I'm already at $10,000. In just that quickly, I went from $10 to $10,000. Now, if the odds were actually even, I would probably eventually win. It's extremely unlikely you're going to flip a coin and get heads 20 times in a row, right? But it is much more likely that I'm going to go broke than the casino is going to go broke, but not if I'm Bill Gates, because if I'm Bill Gates, I can go 80 times before I run out of money. And statistically, the chance of a coin going heads 80 times in a row, or a roulette wheel going red 80 times in a row, is so infinitesimal that I could almost risk $1 billion. But the problem is, I'm risking $1 billion, but I'm only going to win 10. I lost and I lost and I lost and I lost, and I keep putting more and more money in and losing and losing and losing. And when I get all the money back, I'm only going to be up 10 bucks. But I'll be up 10 bucks if against like 80 losses. I'll be up 10 bucks almost every single time from now for 1,000 years. So if I can sit there and play and play and play and play, I can make some pretty good money. But a computer model will show you that eventually you will go broke, because it will happen more often than you think, that it's just going to come up red, 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 red. And by the way, that's why they have those screens on a roulette wheel. Roulette wheel screen. Let's see if these, you know what these are, right? Why? This thing is so weirdly slow. I don't know why this is happening. Anyway, oh, there you go. See this? Oh, look at this. There's a good example. Look what happened here. There's blacks, but if you look, there's like, wow, 3 red, black, 4 red, black, 4 red. So you'd say, this table comes up red a lot. That's why they have these screens. They have these screens because they want you to think you see a pattern. They want you to go, ooh, look, 21, 21. Look at that. Ooh, 21, 21. That's, I should bet on 21 on this table. Look at this number, 25, 36, 27, 23. Look how much of it comes up in this part of the table. So if I bet this third, I should do pretty well because it often comes up there. It's complete bullshit. It is a almost, in fact, they want it that way. That's why they calibrate their wheels very carefully. They want it to be completely random. The more random it is, the better it is for them. Well, look, there's the 00. So you see that in how many of these? 3, 6, 7, 11, 13, 11, 13, 11, 12, and 4 is 16. So here's 32. Here's 32 spins, right? In 32 spins, we see this table turned up red a lot. This table turned up black a lot. This table had the 100 that you would expect out of 32 times. So that's the other point. That's why the casino has multiple games, just like we have multiple stocks and we diversify our positions. They diversify their games and they diversify their tables. So this table came up red a lot. This table came up black a lot. This table got the 00 where they wiped out everybody because nobody bet on 00. The more times they have people, the more people they have playing, the more games, they will statistically come out exactly where it should be. And statistically where it should be is almost a 9% advantage for the house playing roulette. So of course they want to play a lot of roulette. And of course they want to do whatever they can to entice you to come play roulette. Okay, that's what we're doing. When we say be the house, it's because we have a huge advantage when we're selling premium. So, oh, damn it, I lost my thinkorswim. Nope. So when we sell the options, we can get it off of this stuff though. Where's my thing? Oh, here you go. Okay, so So here we sold these 2027 January 120 calls. 120 is way out of our range. We don't expect that because what we expect if the S&P drops 20%, and we do not think it will, not the S&P, the NASDAQ. If the NASDAQ drops 20%, and we don't think it will, this is a 3 times inverse ETF. So we think that the 3 times inverse ETF will go up 60%. So the current price is $72, 72.18 times 1.6 times 1.6 is 115.48. So we think 120 is outside of the range that the S&P is going to drop. But meanwhile, our 55-100 spread is going to be perfectly in the money. So what have we done? This guy paid us $15 betting that the S&P will be higher than 120 next January. He paid us $15. That's premium. That's our spread. We sold a spread that we think is out of the bounds of reality, out of the bounds of logic. We don't think the NASDAQ is going to fall 20%. And if it does, it doesn't matter because we have 200 longs. So, you know, frankly, it's pretty covered. But if it happens and if it falls like that, then that's our spread. So, and we're getting paid a lot of money. I mean, the amount of money we got paid is $69,000 against the spread is 372 minus 498 minus 372 is $116,000 spread. So on $116,000 spread, using half of the time that we have on the spread, we got paid $69,000. That's basically, that's not basically, that's more than half of what we paid for the spread. We collected back as a premium fee outside the range of our expected range for the NASDAQ. So we're playing the game, and it's like in the roulette wheel that there's a 0 and a double 0, but we sold this guy 000, which isn't even on the table. He paid us. Now, it is possible that the NASDAQ could fall 30% and we could be kind of screwed, but not that screwed, because if the NASDAQ falls 30%, then we'd be at 72.18 times 1.9, because it's 30%, so 30% times 3, so it'd be times 1.9 would be 137. Well, that's not that bad, because then we would only owe this guy $17. So $17 times 4,400 is $74,800. We're only giving him his freaking money back. If the NASDAQ falls 30%, we only give him his money back. Meanwhile, our spread will be worth $1 million. Yeah, that's $1 million. It's going to go from 116,000 to $1 million at 100, and we only have to give this guy back his $69,000. If the NASDAQ falls 40%, it gets ugly. But if the NASDAQ falls 40% and we sit there like idiots and don't do anything to stop out these numbers or anything, then we deserve what we get, right? Because we don't know what we're doing. But the statistics and the math let us know that this is how we're going to make money over the next 2 years. We're either going to get our money back by selling more short-term premium, and therefore we're taking essentially no risk on this insurance play, or if the NASDAQ does fall, then we may have to pay this guy back some money, but since we're going to win $900,000, it really doesn't matter. Oh, and by the way, don't forget we collected the $69,000. So what we did is we laid out 498,600 minus 372 minus the 69,872 we sold, 69,872. So our net outlay on the $1 million spread is $56,000. But again, come next January, these calls, this is in the way. So come January 2027, these short calls will expire. And if they expire, we get to sell more short calls. And then our net cost will go to zero or below zero. And we still have $1 million spread. So this becomes essentially free insurance. And not only that though, but we sold 30 March calls for like $5. So we sold $15,000 worth of March calls and we bought them back for $2. So we made 3 times 30, we made $9,000 on short March calls as well. And those we keep tight stops on. Those we make sure we put a stop on, and if it gets away from us, whatever. So we're not taking a huge risk, especially out of our $1 million potential, because the only way the March calls can hurt us is if our long spread goes further in the money. So yes, there's a lot of moving parts, but those parts are part of a mathematical formula that we can get our arms around and we can predict, and we can have a very, very high degree of certainty of how it's going to behave, because it's an index and entire indexes don't suddenly jump up and down 10, 20% like stocks do, and especially like stupid meme 100 times earning stocks do. We don't want, when we make a bet, we don't want the stock we bet on to go up too much, and we don't want it to go down too much. We generally want it to stay in a 20% range, 10% up or 10% down for the most part of when we're earning, when we own it. So we don't want to get a stock that's too much of a bargain, and we don't want to get a stock that's too high either. We like a steady stock. We like a big, bulky, battleship size stock. Now, unfortunately, in today's crazy markets, even trillion-dollar stocks can go up and down 10% very quickly. It's annoying. We have to adjust, but we do make our adjustments when we have to, and that's not a big deal. But the key is knowing which tables to put in your casino. So our selection process is looking for stocks that are not likely to make gigantic moves, being bought out. The worst thing that can happen to us is a stock gets bought out or it goes bankrupt, because either one of those things means we have to stop playing. And we don't want to stop playing. We want to be able to roll and adjust and move to the next year. We want to keep playing, just like a casino will send you a jet to bring you back to the casino, right? Not everybody does this, but if you win a ton of money at a casino, you walk away with $2 million and have a really great weekend at the casino, they will fly you back. But, and by the way, it's essentially understood by the player and the casino that they will fly you back with the $2 million or $5 million minimum that you're going to go and play. They don't just fly you back and say, have a nice weekend. They expect you to play at the table. They can't force you to, but if you don't, that'll be the last time they fly you back. But these casinos will fly you back and give you a suite and treat you like a king, even though you beat them, or especially because you beat them, because you're expected to go back and play and give them a chance to win their money back. And again, because of statistics, they are fairly certain they're going to win their money back if you keep playing. But the worst thing you can do is stop playing. Therefore, for us, it's the same thing. If a stock goes up and beats us and gets bought out, we can't keep playing. If a stock goes down and bankrupts and stops playing, we can't get our money back. We can't keep playing. Now, obviously, we can get our money back by just moving to another table. We can just switch the game. So it's not life and death, but it is annoying for us. And also something can happen suddenly. One terrible thing that happened to us was China Telecom. We had a pretty big bet on China Telecom, and then the government sort of made trading China Telecom illegal, like very suddenly, and we were stuck because the next day they froze the accounts on that stock, and then when they reopened it, it was plunging and nobody was trading it, and we were stuck. Basically, we were stuck in the thing that devalued very rapidly. Now, as it turned out, they were no longer trading in the US, but we were given Chinese shares and we were able to cash out Chinese shares, and it wasn't devastating. It's just a minor annoyance in the end. But in the US, if we had panicked and gotten out of the stock while it was going down, we would have lost a lot of money. And if it had gone bankrupt, we played a telco stock called Frontier once, and Frontier suddenly declared bankruptcy. It turned out they had been basically lying in their annual report. So we're reading these reports and going, hey, they're doing pretty good. It's just down a bit, blah, blah, blah. But then it turned out that it was all bullshit. They were in terrible financial condition, and they had already arranged to exit through bankruptcy so that the shareholders got screwed and lost all their money. But the owners of the company, the insiders, they transferred to another company and sold all the assets of Frontier to the new company, blah, blah, blah. It was a con, but what are you going to do? You know, it happens. But anyway, so, you know, we have our hedges and we hedge our hedges, but we're hedging our hedges statistically in a way that the math says this is very, very, very unlikely to hurt us. And so when we have a nice dip like we're having right now, if we can see it, oh, here's the NASDAQ. Okay, so when we're having this nice dip in the NASDAQ, we say, oh, that's good. Now maybe we want to sell some more short calls. But we're not going to. We just had a chat about that of whether it's done going down. In fact, let's take a look at that. Okay, so high expectations, the growth, the sentiment we talked about, energy and consumer under pressure, tech comms leading the charge. This is all in the post. I'm not going to get too over. The outlook overall, AI productivity gains are showing up. So that's what the morning report is all about, is how earnings season is going. We had the roundtable doing analysis of it. This is going phenomenally well using the roundtable consulting to figure these things out. I made a point about United Health is like, you know, all this work, 88 billion, 13 billion, 10 billion, blah, blah. They got to get all these people to give them money. It's 113 billion in revenue. They have $112 billion in operating costs, and they do all this work to make $200 million. And you know what's really tragic about that is the medical costs are $82 billion. So they jacked the medical cost up. $31 billion divided by 82 is 37%. United Health adds 37% to the cost of your medical care, 37% being $40 billion. They add $40 billion to the cost of your health care so that they can make $200 million. That takes inefficiency. There's not a word. Inefficiency is not a good enough word to describe this. They're a middleman standing between you and your doctor, ostensibly to manage the care and so on and so forth, but it's bullshit. They're responsible for 37% of the healthcare costs. And it's actually more than that, because frankly, if you were negotiating with a doctor and the doctor told you it was going to cost you $40,000 to have a baby, you would say, you know what? I'm going to go back to the old midwife system, because that's what they do in most countries. In most countries, they just have a midwife, and the midwife is at your house and taking care of you, and you have your baby, and the midwife is a trained person. And if something goes wrong, then they call an ambulance and take you to the hospital. And I don't mean if something goes wrong, like they don't know until the last minute. If the baby looks okay, if it's in the right position, if everything is going well with your pregnancy, you're going to do it at home. If not, they're going to take you to the hospital and have the baby that way. But 9 out of 10 pregnancies are just fine. You don't need to spend $40,000 9 times just in case something goes wrong, especially because you can tell something's going wrong a lot sooner. Not always, obviously, but you know, within the bounds of reason, you can tell if a baby is normally coming along and whatever, blah blah, you know, and all the pregnancy looks okay and it should be right. And if you don't even be taking into consideration, I live too far from a hospital to be sure. So go somewhere closer to the hospital to have your baby. You don't have to go in the hospital to have your baby. You don't have to check in just in case and have millions of dollars worth of equipment standing by. Obviously, you know, for your state of mind, yeah, but look at what we're doing. Look at what we're spending. It's insanely inefficient, and this proves it. There's no profit in this. If you ask a rational human person, you know, like a 20-year-old girl or 25-year-old girl is having a baby and she has no history of problems, and the gynecologist is happy and everybody thinks everything looks good, blah, blah, blah. And you say, would you like to spend $40,000 or $2,000 to have your baby? They're going to say, I'll spend $2,000 to have my baby. And just like anything, well, what if this 1 in 1,000 thing goes wrong, blah, blah, blah. Of course. But it's ridiculous to cover the 1 in 1,000 thing all the time for every single person on an effectively mandatory basis. It's like that with a lot of stuff. And there's so many things that are just so insanely priced because these monstrous healthcare companies feed the system. But the key thing here is it's $40 billion. So they could make $200 million. And that's just one company, 1 quarter. This is where all our money's going. This is, and then you expand that to Medicare and Medicaid. 37% is $3 trillion. That's $1 trillion a year. We only, and only is a weird word, we only have a $40 trillion deficit. If we simply take $1 trillion a year that we're wasting on Medicare and Medicaid, and again, it's not Medicare and Medicaid are not wasteful, it's the whole system that's doing this. But because who runs Medicare and Medicaid? UNH, obviously. If we take that $1 trillion a year and put it into paying off our debt in 40 years, we'll have no debt. You know, it just makes no sense what we're doing. And so you can understand why somebody shot the healthcare guy. So no, I mean, it's a horrible, horrible thing. They shouldn't be allowed. A rational government should be taking these guys and throwing them out the window. It's not good for the country. It's not good for our citizens. It's not good for the people. It's not even good for the hospitals and doctors. Every other civilized country on this planet has universal health care because it is cheaper and more efficient, and you get better outcomes. But again, not what I'm here to discuss. I'm just pointing out in passing that this is ridiculous. This is not a company you invest in. I have a company that takes $113 billion of revenue and makes $200 million. You see this number here, this 0.2? Look, that 0.2, that's their profit. The rest is expense. So they're like one little slip up away from losing money. So that's a bad casino game, isn't it? You know, it's a good casino game. Oh, this is going to be flippy. Look, Samsung. Oh, it's a thingy. Let's see. Tesla makes basically no money. Starbucks makes no money. Look at that. See, that's why these charts are good. Look how fat that is. Visa makes a ton of money. Samsung makes good money. Samsung makes 19 trillion, whatever the frick they are. Won, I guess. Visa makes $6 billion. They see that 19.6 trillion Korean, whatever they have in Korea. Visa 6 billion, but you can see how fat it is compared to the expenses. That's the key. When you see this, red flags, warning, danger, get away. This is not a business. It should not even exist. Because it's not about the profit, it's about paying, it's about these operating expenses, operational costs, $17 billion. You know what that is? That's their salaries. That's the executive salaries. That's the people who work at the place taking the money. This is a job creation scheme for these people. All this whole scam is so these guys can get paid. Not the investors, these guys getting paid. That's the entire scam. And they needlessly bill you $40 billion a quarter just so they can get their salaries. There's no reason for them to be there. There's no reason you can't just pay a doctor. When you go to the doctors, even if you pooled the money, if everybody in America could pool their money into a JP Morgan account, right? And then when you need money, you just take out your JP Morgan card, which is gathering, instead of you just giving your money to UNH, what if it just went into a gigantic pool that tracked the S&P and it gathered and it built up over time, right? But whenever somebody needed something, when someone had an actual medical situation, they just hand their JP Morgan card over to the doctor, and the doctor says, "Thank you very much, taken care of." It's a huge account. It's like Harvard's endowment, right? Like Harvard doesn't need to charge tuition. They have an endowment that makes more money than all the tuition that comes in every year, and the endowment just grows and grows and grows because it's over covering the cost of tuitions. And it's more than they need for the buildings, it's more than they need for the grounds, it's more than they need for all the labs and equipment and so on and so forth. They've got much more money than they could possibly use, and so they invest it and they make even more money, and they've got $50 billion, $60 billion, whatever it is they have these days. For what? You know, as a student, you should be insulted that they're taking your money. Why are you taking my money? You don't need it at all. That's how healthcare should be run, like an endowment. That's what other countries are. They're an endowment. Healthcare is paid for, but they don't even ask the people to pay it. The government says we're setting up a fund to take care of healthcare. Obviously it comes out of taxes and whatever, but so what? It's a hell of a lot more efficient than letting these guys suck it up. And they'll argue, oh, we negotiate, blah, blah, blah. They don't negotiate shit. Medical costs are completely out of control. Like I was saying, $40,000 to have a baby is not negotiated. And again, you just sit down with the doctor and say, do we really need to spend this much money? Do we really need to put a person in a hospital to have a baby? Something people have been doing for millions of years without hospitals. It's only like the last 100 years that you go to a hospital to have a baby. I'm not even sure it's 100 years. I'm pretty sure in I would have to say that I know my mom had me in the hospital in 1963. She went to the hospital, didn't think she shouldn't go. I'm not sure. She was born in 1940, maybe in a hospital. So yeah, let's say 100 years. Okay, I'm going to call it 100 years. So for 100 years, we've decided that we're going to have our babies in hospitals. Is it a good decision? No. Could you have a birth clinic outside the hospital, on the hospital grounds, that had a different, you know, like I said, a midwifing staff, and didn't have all the equipment and didn't take up the hospital rooms and so on and so forth? Well, yeah, you could do that, but what good does it? Why would the hospital do that? The hospital wants to bill you $40,000. They don't want to bill you $3,000 to have a baby. They don't want you to check into like a nice hotel room with a nurse and staff on call that's down the block from the hospital in case anything goes wrong that can be immediately taken care of. That would be logical. That's negotiating. Anyway, again, I'm going to get all stuck on this and I can't get past it, so I'm quitting. I'm just moving on. Oh, shit. Oh no, and I'm not even logged in as an actual user. Oh. That old problem again, right? We had that before. Mm-hmm. Oh, now we ever gonna get to the other portfolio? La 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 la. All right, so there are games we want to play, and there's a system that we have in place. But if we follow the system and we play the right games, we're going to win very, very consistently. And that's the main theme here. Figma, that's what we were talking about. So Figma. So somebody asked, Marco asked about Figma because somebody tweeted something and he said, I heard a tweet. Anyway, so Figma IPO'd here in August last year, and they went down and down and down and down because the whole thing was idiotic. And they're all the way down here. That doesn't make them a bargain. They never should have been this high. These people were idiots. They have no idea how to value something. And the more people heard, here's earnings, those earnings were good, these earnings were good, but they weren't that good. They don't make enough money to justify the valuation. They're trading at more than 100 times earnings if they actually make the earnings they're supposed to make. We don't even know if that's going to happen. So it's not a stock I have any interest in. I want a stock that makes more money than a bond. So a bond is 4% basically. 4 to 5% is a bond I have to make. That means therefore I need to make 20 to 25x is as much as I can tolerate for a PE ratio. Otherwise, I may as well buy a bond. At least I know I'm going to get my 5%. 5% is 20x. That's how you figure it out. Here's AMD. Also priced to perfection, priced to a point that they finally, they even with great earnings, it's not that great that we should be spending 40, 50x what they make. Here's Eli Lilly, and here's Novo. Novo also, they had their guidance. Their guidance wasn't bad. Their earnings are a beat. People sold it off because they wanted better, they wanted more. Now, I played this wrong. We have to change our position because we thought that they were going to squeeze higher. They squeezed lower because they guided down. Here's Bristol Myers. Bristol Myers is way cheap right now. It doesn't look cheap on this chart. It's not long term enough, but they're trading at 10 times earnings. 10 times earnings is 10%. That's right where we want to be. So we pick up the spread, we sell the premium, and we just go through our process. Those are the kind of stocks we want to be in. Here, what do we say about this one? Oh yeah, here's LegalZoom and Thomson Reuters. Both of them sell legal services. And Anthropic, who makes Claude, just came out with like a Claude that basically does what they do. It does what they do, except it charges 1/10 as much because it's just done by an AI. You know, what is LegalZoom? LegalZoom provides a form. So if you're having a dispute with your landlord, if you want to do a will, if you want to make up a partnership agreement, LegalZoom will make the form. Now, Anya, and well, we don't have time, it's 2:15 already, but Anya, who I've demonstrated here, if I call her, not only will she make the form, but she'll fill it out. She'll take the notes. She'll ask questions to clarify my intent. And that's not, Anya's not based on this. Anya's just smart. So Anya knows what a freaking form looks. You know, she knows what the landlord-tenant agreement should look like. And she says, do you have any pets? So, you know, any pets? I don't need the pet section. Do you have any kids? Do you have this? Do you have visitors? Are you after this? Do you have noise issues? Blah, blah, blah. She will go through the thing intelligently, not a standard customized form with a lot of crap you don't know about, but she will just sit there and ask you questions and say, okay, boom. And she'll print out a custom form as if you went to an attorney and spent $500 an hour to do that. So it's exactly what LegalZoom does, except that somebody who understands the law is working with you on the form and changing it as you need it. But she's got access to the exact same template they do. It's just a template that lawyers use all over the country all the time. But she can modify it without, you know, well, that's LegalZoom upsells legal services. They say, oh, you can just have a form, but then as soon as you see the form, you're like, I don't understand this. And they go, oh, well, we have a guy who can interpret it. Anya will interpret it for you and talk to you about it. And she'll pick the right form. God forbid you're doing anything complicated, like you know, certain business agreements or trade agreements or whatever. You know, you know, there are 100 forms on LegalZoom. You don't know which one is right for you. They probably have like something where you ask questions and whatever. But it's the same thing. Anya's just going to say to you, okay, so what are you trying to accomplish here? And then she'll ask a question and she'll check it out and she'll clarify. And then she'll, oh, here you go, boom, here's your form, customized for you, with your name on it, with all the parties involved that you tell me about, and so on and so forth, all done. And if you need to modify it, that'll be 5 seconds, please, and she'll modify it too. That's the future. Whether it's through Anthropic's Claude thing or not, that's the future, because my guys can do it. Their guys are starting to be able to do it also. So what's the point of LegalZoom? There is no point. Now, some companies are going to be better, like let's say Morningstar. Like I can tell you, we could put out a Morningstar report that's as good as Morningstar, but they are on the ground, and this is what they have to cling to. They're on the ground interviewing CEOs, talking to the CFOs. They've got people who are experts looking at the company. They've gone a bit deeper of a bench than we're going to get from our surface transaction. We can gather that information if we wanted to, but they've already got the people on the ground. They're like newspapers that have actual journalists out in the field. That's different than the news gathering services that most of these places are. So, you know, the bots are only going to be as good as the information that's being given to them, but given the same information as Morningstar gathers, they could easily make the same exact report as Morningstar makes, or probably better. And that's what we're doing now with the roundtable. These reports, this report, as you see, Quixote, Zephyr, Anya, they're just having a conversation about the data. They're having a conversation about the earnings data and pointing out the things that you should be paying attention to. And that's what the roundtable is. They're actually sitting there talking to each other and creating a consensus report on the market or on whatever. You know, it could be a consensus report on the market. It could be a consensus report on your legal situation. It could be a consensus report on your medical situation. It could be how to build a house. It can solve the energy crisis. Whatever you need to do, they can do that for you. That's the point of it. Here's Tesla, and we expected this to happen. They broke under their support, and they're in big trouble probably. because again, 200 times earnings is insane. There's Adobe also. Adobe, we decided that, see, everybody's extrapolating. It seems like Adobe's in trouble because there's all these things that the AIs can make images and so on and so forth, but they can't make a great image. They're not artists in a real sense. So you're still going to need the kind of people who use Adobe and are creative, like my daughter Madeline. In fact, she is an artist, and she doesn't like AI, as most artists don't, because it's a threat to their existence. But and it's a shortcut, and it makes them pissed off because they spend 20 years practicing, and then all of a sudden this program comes along and can do a Picasso for you. But still, there's the little things of creativity and so on and so forth. And I just did an advertisement, in fact, and the advertisement came out great, but it needed some nudging around. It's not a finished product. It's a nice sketch, but it's not what you'd expect from a professional illustrator. Will they get better? Yeah, they'll get better, but you know what? The artists get better too, because they get better tools and they're able to do more and cooler things and come up with ideas and so on and so forth. So Adobe is still the state-of-the-art tool, and it still is a thing that a creative human is going to do better than an AI. It'll be a long time before it's something people don't want anymore. Here's Bitcoin crashing out. We've been watching that. Oh, this was a point I made. What I made? Oh, I know why I made this point. I said because Bitcoin's not worth anything. I said, remember these Bored Ape things? This exact one sold for $3.4 million at Sotheby's 4 years ago, October 26, 2021. $3.4 million for this picture that was never, no artist ever drew this thing. It was just done by an early version of an AI. They did thousands, I don't know how many, 10,000, whatever, some giant amount of them. What's the number? Is it 10,000? 10,000 cartoon apes, each one different in some way, shape, or form. This is ape number 8817, and this one ape sold for $3 million. There were 10,000 of these things, and Sotheby's, a serious auction house, sold it. Again, there's no painting, there's no picture other than the digital thing. You could obviously print it out on a printer, but there was never an actual thing. There was never an actual artist. All you're paying for is, where's the ID of this thing? I think it's this. Yeah, BAYC 8817. You know what that is? That's a Bitcoin. What they're selling, an NFT, is a unique ID that represents an image that has been stored on the Ethereum blockchain. So essentially, it is nothing more than a Bitcoin with a picture attached. It's a unique item, a unique serial number that cannot be duplicated, that is associated with this image. That is what an NFT is, non-fungible token. And it is no different than Bitcoin, except Bitcoin doesn't have the picture, it just has the number. So when you get a Bitcoin, you're buying BTC 8817, obviously a much longer number, but you're buying a BTC and a theoretically uncrackable long number that is uniquely yours, as in the ownership is transferred to you, and you are now the owner of BTC, whatever. Is it different? No. There are 21 million Bitcoins. There are 10,000 NFTs of this Bored Ape, but there's millions and millions of other NFTs too, and the whole market crashed completely because it's completely worthless. Bitcoin is worth exactly the same as these NFTs. In reality, it has no value whatsoever other than whatever people are willing to pay for. In fact, you probably have a better chance of getting a hamburger from McDonald's in exchange for this than you will from a Bitcoin. because what are they going to do with the Bitcoin? At least this can go, at least this they have the license to put it on their menu and put it on the wall or whatever. But with Bitcoin, it's just a freaking number. It's a big, long number. That's what you're buying. So Bitcoin is down here. Now we just doubled down on our Bitcoin calls. We have June Bitcoin calls. We think that it's going to bounce, and we think the bounce is going to be, what is this number, 43? So it fell from 43 to 32, which is 11. So about 11 points down. So we expect a 2 and then 4. So expect it to get back to like 35, 36. And so we think our calls will hit like $7 at some point, and we will get out and we will be happy with 50% gain. Goodbye. That's it. It's just a momentum play on the bounce. No big deal. H&R Block, I was disappointed because we picked H&R Block and they went down and down and down, but we stuck with them. And now they finally had earnings, and earnings were good. And now we got to wait and see if they bounce back enough to make us happy. And T. Rowe Price also stupidly cheap down here at $95. We like them. Oh, fundamentals. So yeah, so we talked about, Elon Musk. Another one you're going to get me stuck on. Elon Musk has XAI, which is just another AI company that's not as good as Anthropic. It's not as good as it's Grok. It's Grok AI. It's not as good as Anthropic. It's not as good as OpenAI. It's just a run-of-the-mill AI company with no particular great fee. Oh, Gemini, Google's Gemini is much better also. So there's nothing special about it. It's a Me Too AI company. And he's never going to get his money back out of it. And he's never going to get the money he needs to build to compete because he doesn't have an edge. There's no reason for it to exist. It's just a way for him to say, I have AI too. But he sells the AI now to himself. And in order to justify it, he's using SpaceX, which is a company that does make money. It doesn't make anywhere near enough money to justify its valuation, but it does make money. And the rockets and stuff, they get paid for these launches to bring things into space. So like a space cargo company. And theoretically, space is a growth industry. So now, and we're back to the circle jerk thing, right? Because now he's going to merge XAI with SpaceX. And so what's going to happen? XAI is going to pay SpaceX with the no money they don't have, is going to pay SpaceX to take to build the AI data centers in space, or launch AI data centers into space. Either way, it's just stupid. And then SpaceX is giving XAI money so that they will have money to give SpaceX to launch data centers into space. Right? Stupid. You know what's even stupider? The fundamentals of it. We talked about this because RN brought it up. And he said, what's the rationale for space data centers? The Earth is a significantly better heat sink than space. I tried doing the math behind this, and I ended up a square kilometer of radiator area. In other words, he's saying it would take like a kilometer. He's actually low. But the thing about space, and this is where the con is, okay? Because when somebody's trying to con you, or not even con you, it's with the fake news, right? Like you hear the fake news all the time. There's always like a little thing that's kind of true. So the little thing that's kind of true is that space is cold. Space is cold because there's no heat in space. It's not cold because it's inherently cold like an ice cube. It doesn't suck the cold out of things. It is just cold because there's no heat there. Space is cold like like when you touch the inside of a thermos and it's cold because no heat is getting in because it's a thermos. It keeps the heat out. It keeps cold in, it keeps heat in. It's not a good transfer of either heat or cold. That's good. You don't want a good transfer. And why is a thermos not a good transfer of heat or cold? Because it's surrounded by a vacuum tube. That's what space is, a vacuum tube. And so if you put something hot in space, it stays hot. If you put something cold in space, it stays cold. Space doesn't affect the thing. So that's the problem, because the heat in space, the heat from a data center, from the chips running electricity and burning hot and becoming incredibly hot, the heat isn't going anywhere in space. It's just going to build up and build up and build up on the chip. You can't blow on it because there's no air in space. You can't cool it with water because there's no water in space. There is no way to dissipate the heat other than what they call radiant energy. So in other words, what you do is you set up giant thin strips of metal that would have to extend, as RN said, for miles, and pull the heat away so that it eventually dissipates into space. But again, that would be tricky too, because the heat would really just sort of like, the metal would heat up, and there's no particular reason for the heat to leave the metal. And you say, well, how about you spin it or something? Well, you spin it, but it's still not going to go anywhere. The heat's just going to stay where it is. You didn't do anything to it. It's just there. It will eventually dissipate, but you know, it's not going to do it in a way that's going to cool a chip. So you know, they use the fact that space is cold to say, oh, space is cold, let's put the chips up there, no problem. That's how cold works on Earth. It's not how cold works in space. These are fundamentals. And this is the same thing when companies say they're going to do this and that bullshit. You have to think fundamentally, how do they accomplish it? How does it actually work? So anyway, so there's no atmosphere to carry the heat away. It's a whole big mess. The whole thing is much more complicated than you think it is, not to mention the fact, you know, we're talking about a kilometer or a mile of material that would have to be like a big giant sort of like a disc, like a satellite disc sort of shape thing that would have to dissipate the heat away from the data center. And then he wants to build 1 million of them. So you're talking about millions of miles worth of material hauled up into space to dissipate the heat. And also there would have to be material to collect the sun's radiation to power the data centers. It's so enormously huge and complex and ridiculous that you should just build the freaking data center on Earth. The whole thing is nuts. And you're going to send up 1 million of them. You're going to send up payload after payload. But what is it? It's a bullshit science fiction fantasy that sounds good because people know space is cold, and therefore Elon gets to say, and the moron analysts on TV who don't do any research and just spout off whatever bullshit that the PR people tell them. They go, oh, space is cold. This is brilliant. We're going to move all this to space. We won't have to worry about the resources on Earth, and this will solve all the problems. And meanwhile, Elon gets to write on a spreadsheet and say, XAI will launch 10,000 missions, carrying 100 satellites per mission to launch. Meanwhile, though, you know, nobody in their right mind believes that you're going to launch a data center, which is still a data center, which is major tonnage. You're going to have miles and miles of material around the data center to solar panels to collect the heat, and then some sort of material that radiates the heat away. And And how are you going to do this? And what are you going to do? Block out the sun completely? And what's the repercussions of this? And who's allowing this? Does the United Nations agree to this thing? No, there's no United Nations anymore. We're decommissioning them. So, you know, that's the kind of thing that you would hope that the world would agree on. And frankly, if the world doesn't agree on it, then China and Russia can just go up there and bash your satellites out of the sky. It is ridiculous. But that doesn't matter, because look how many idiots are going to believe that this is the future, and they're going to be able to say, oh, SpaceX, it's going to be the world's first $100 trillion company, because if you take all the money that XAI is going to give them, and don't forget XAI is owned by Elon Musk too. XAI is signing a contract to pay them $50 trillion to launch all these satellites into space. Therefore, they're the greatest company ever lived. And none of it, the whole thing is never going to work. And XAI doesn't have the money, and SpaceX doesn't have the materials, the rockets, or anything else. And it's just a joke. But you know what the joke is? The joke is SpaceX is going to go public with $1 trillion valuation, based on the fact that they're going to make $100 trillion launching rockets, and people are going to do it. People are going to give them $1 trillion, and Elon Musk is going to that's $1 trillion for what, 5% of the company, 10% of the company. So the company will be worth $10 trillion, and then everybody's going to go, oh, Elon Musk, oh my God, he's now worth 10 trillion. You know, he owns this much of SpaceX. He's worth 5 trillion, $4 trillion. And you know what? He will be, because that's how it works. And he'll be able to go to the bank and write loans against it. And all they have to do is launch 2 rockets this year, and 5 rockets next year, and 10 rockets a year after that. And they're going to show on a chart, like, look how fast we're growing, blah, blah, blah. And then Elon will come up with another scam in a few years to get your money. And you'll forget about SpaceX and the thing. And you know, like 10 years from now, people just like with the just like with the Cybertrucks, that we finally got Cybertrucks. But 10 years later, everybody's like, whatever happened to that thing he said he was going to do 10 years ago? It'll be, I guarantee it'll be flying, next will be flying cars and things like that. So we were, okay. So then we talked about our hedging, and now we talked a little bit about the hedging in the short-term portfolio. We talked about that this is an old chart. For us, it's an old chart. We've been tracking this since the fall, and our prediction has been the whole time that this would be the top. And as you see, this is the top. And then we predicted we would fall to this line over here, the 600 line on QQQ, and that was going to be our range. And if you look down here, you see this down here, that indicates that this is indeed the bottom of our range for now. Although what's going to happen is, you see this 50-day moving average is going to fall below the 200-day moving average and form what they call a death cross. Or actually, these are the hourly moving averages, but you know, there will be a death cross formed, and things are going to get ugly. So this range will shift, but for now we can rely on a bounce down here, which is what I think we're getting right now, right? Yep, bounce. See? And that's how we base those getting back into the short sales and making more money. It all works great when you have fundamentals and you have a plan. But the fundamentals have to be based on reality, right? Not based on Elon Musk bullshit or things like that. Not based on FIG, not based on any company's bullshit that has no possible way to really measure it. You know, Coca-Cola says we're going to make $4 billion next year. How are you going to make it, Coca-Cola? Well, we've got this many trucks and this many people, and we buy this much sugar, and we buy this much aluminum, and we put it into cans, and we fizz them up, and we do this stuff, and we sell the marketing, and we've got the people here, and we have our distribution channels, and we have 20 years of history, and we can predict, you know, and we have a history of not just of the sales, but we have a history of accurately predicting our sales for 20 years, where we're only off by 1 or 2% at the most ever, because we know our frickin' business. and we trade at 15 times earnings. And I say, oh, that's 15 times earnings, 6%. That's pretty good. That's a pretty good annual return. Well, Mr. Coca-Cola, I'm happy to give you my money as an investment because I trust you to return my money in 6 years. That's my rate of return. I'm going to make, or whatever, in 15 years. I'm gonna make 6% from you in 15 years. But what we do at PhilStockWorld is we say, oh, we can augment that 6% return and we can add a layer of options to it and we can turn that into a 20% annual return from the Coca-Cola company that is super reliable and will always be there. And I would rather have that than all the gambling that you want to do. And you know why? Because the most successful investor of all time, by far, no question at all, Warren Buffett. And Warren Buffett, over the course of 50 years of investing, made 16% a year. That's his average. Some years he even lost money, but not many. But he generally made 16% a year. And that compounds and compounds and compounds until a person who invested with him 50 years ago has 100 and something thousand times more money than they started with. So if you gave him $10,000 in 1960, you now have $100 million from investing in Berkshire Hathaway. That's what it's about. Consistent, reasonable rates of return that we are able to control because we understand, and Warren Buffett says this too, if you don't understand the thing you're investing in, walk away. Do not invest in things you do not understand. Do not invest in things that if the market closes tomorrow and doesn't open for 5 years, that you don't have a 99% certainty that that business will still be functioning. That if you can't touch it for 5 years, it'll still be there. Do I feel that way about Coca-Cola? Absolutely. Do I feel that way about Fig? No. Do I feel that way about Tesla? No. Ford, GM, Toyota, utility companies, Pfizer, AT&T, no brainer. In fact, I always remember 2000. I don't remember what year 2001 is. The 2001: A Space Odyssey, which I believe was made in like 1970 or something like that. Their prediction of the future in 1970 was one of the scenes in the thing was the guy made a video call home on AT&T. It had the AT&T logo back then. So that's like 50 years ago. Arthur C. Clarke, who was very good at predicting the future, predicted AT&T would be your phone company 50 years later, and yes, it was. You know, some things are just not going to change. They're going to be similar. And AT&T, don't forget, got broken up and got back together and so on and so forth. Doesn't matter. Now, what was the other thing? There were two things we were going to look at. Oh, yeah. Home. Oh, and this is the same thing. So let's, yeah, this is, oh, good transition. So we have 15 more minutes. Sorry, it was an abbreviated thing today. But here's our $700 a month portfolio. So speaking of investing and slow and steady returns, we were only trying to make 10% a year because that was realistic and expected. That we had a really good market. We made a huge amount of money, and that huge amount of money is allowing us to make more aggressive bets much earlier in the cycle than we thought we would. And we are already at $93,000. So it's been 42 months. So you put in $700 a month, times 42 months. We put in $29,400 and we have 93. So we made 60-something thousand dollars. We're up 200%. I'm sure that number is over here somewhere. Oh, maybe not. All right. Anyway, So we're up about 200%, and it's been 3.5 years. So we're averaging 62% a year. So I'm not going to get into the math of the thing and so on and so forth. Obviously, the S&P has done really well, so it's not like we did this by magic. It's the market doubled. That's helpful, and we've been ahead of the market. You can see every single trade we made going boom, 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 boom. This is the last 12 months. And here's the current portfolio. 217% we're up. We have $30,000 in cash. We made a bunch of adjustments, and the adjustments are only, we actually collected $3,000 in all these adjustments we made. We have 90,000, so basically we have 100% of upside potential from the trades that remain in the portfolio. So if we do nothing for the next 2 years, we're going to be up 100%. That does not include income from short call sales and things that we do as well. So we should be able to keep up just with the trades we have. If we just freeze now and don't do anything else, we should be able to keep up that 62%. But why would we do that? Maybe we can get to 90%, maybe, who knows? So obviously we're going to keep taking opportunities when we can, but let's just talk about, because we don't have much time, forget the moves and just go to the portfolio and take a look. These are all the moves we're doing. These are the ones I say good for a new trade. See, wait, no, that's not it. See, of course it's good for a new trade. This one's good for a new trade. This one's good for a new trade, good for a new trade. So ones I say are good for a new trade are good for a new trade. It's pretty simple, right? So if you want to see which ones I really like, those are the ones to start with. Now we have no margin. This is a retirement type portfolio, 401k or IRA. We don't use any margin. So they're all very straightforward spreads. Are very a little bit tricky. Some of these ones down here are little tricks that we use, like where we use ratio spreads, and we use time spreads where we have a time advantage over the short calls we sell. Those are the income trades that we put in here. These are just the very straightforward ones. And what do we got? We have a pipeline company, Energy Transfer. We have a retailer, Helen of Troy. We have iPath here. Sale is a infrastructure play. SoFi is a bank. ULCC is an airline. United is United Airlines. UUU is a metals company, so rare earth. So basic kind of trades that are small companies, because we can't afford Coke and Pepsi, really. It's, we're not looking at those companies. We're picking small companies that have very good stories and should do well in the current economy. H&R Block, Vulcan Materials, American Airlines, which I think we killed them because we had 2 airlines and this one had a short term, or the other way around. I think United we killed. Yeah, we killed United because they only went out till April. I think we gave up on them. Anyway, so very, very diversified. There's Ford. Here's Geo that make the prisons that Trump's putting everyone into. Here's Hewlett Packard. Here's Novo Nordisk, which has just got killed. Here's and here's our hedge. We even have a hedge in this portfolio to see where we're going. And in fact, let's take a look at that. So this hedge was net zero, right? 22 minus 11 minus 8 is about zero. So in that portfolio, what happened to the SQQ? Oh, it's still even. Well, it's not. That's no help. But anyway, so yeah, we've taken a little bit of a hit. We're down to 89 from 92, I think it was before. $93. So we took a hit in a short, in a few days, but everything's holding up well, and the hedges will kick in over time. What we have here is a 70-115 spread, and now we're at 70. So it's just going in the money now. It's only there to hedge against a catastrophic failure. And we sold these short March 70 calls. That's what's hurting us, because the short March 70 calls are now 770. but we have it, so we have insurance in case it goes down and stays down, and we have all these spreads, and we're collecting all this money because we sold the March 13 calls and we're at 14. We sold them for $1.60 and they're only $1.18 in the money. So this is all premium that'll burn off. These March 20 calls, it's at 1940. So they're still 40. So we've still got 188 to collect there. We sold these, nope, forget those. Those are long-term. We sold these June 32s. It's at 45. I mean, it's at 35, so it went higher, and we'll owe that money. These March calls, so these are our games. These are our casino games where we collect the money. Ford's at 13.80. We sold these calls for $1. They're currently $1.07, but they're really worth 80 cents. Geo, we sold the 18 calls. It's below 18, so we're going to collect $2, and that means that the 400 we collected, we're going to keep. It's already down to 190. Hewlett Packard, we sold the 20s. They're at 20, so they're worth 0, and it's 725. And currently, we're showing a loss, but really, we'll collect that 725. Novo's all a loss on these, so these guys will get wiped out for 13.50. We collect that money. PR is at 16, and we sold them for $1.20, so we're going to lose money on that one. So it's a casino. We win some, we lose some, but over time we collect more and more premium, and it adds up. That's how it works, and that's how Warren Buffett's portfolio works. Consistent diversification over time is the way to play it. And I strongly encourage you guys to read the whole review, which looks like that on our page, How to Become a Millionaire by Investing $700 a Month. I mean, this is our strategy in a nutshell. And it's completely available to be read and looked at, and all the things that we've done since the beginning of the portfolio 3.5 years ago. And again, it's $90,000 now. It's on track to be $1 million in 4.5 years. It is on track to hit $1 million in 4.5 years at the pace we're going now. So if you'd like to make 10 times your money, instead of buying some idiotic IPO, just take your money and do this and see how this goes. It only requires $700 a month to be committed by you. You can do it with $7,000 a month and multiply everything by 10 if you're a big shot. But for a normal person, 700, or obviously you can do 3,500 and multiply by 5, whatever you want to do as far as investing. But the key is it's the slow, steady investing. That's called drip investing, right? There's a term for that. And what it means is when the market is low, like it is today, your money goes in and you're buying things cheaper, and then the market bounces back and you're still there buying. And so you catch the lows, and we try to cash out at the highs when we hit them, and try to be smart about not overriding things. And that's how you play it. It's a process, and we're not gambling. We're picking, we pick the stocks based on fundamentals that we think that at this time in this market, under these conditions, the stock should go up. But if we're wrong, if the earnings tell us we're wrong, we'll back off and we'll go find something else, because there's lots and lots of stocks to play. We want to find the right ones that are going to be slow and steady and deliberate, and allows us to just keep grinding out a profit month after month after month, which is what we've been doing for 42 months. And in 42 months, we're up 200 and something %. Just by sticking to the process and not chasing after bullshit stocks, and not falling for idiotic schemes like Musk has and things like that. We say, there's your business, your plan makes sense, the environment makes sense for the plan you have and the business you have, and we see a clear path to holding the stock for a couple of years and seeing it move a bit higher, and we're able to sell options around that give us some leverage, so that as long as you are flat, even if you're down a little bit, if you're down a bit, if you're flat, or if you're up, we're going to make money. The way these trades are constructed, the only way we lose money is if you actually drop like more than 10%. That's when we can start to lose money, and we're either going to adjust or we're going to pull the plug. But that doesn't happen very often because we're very good at vetting our stocks and making sure that we pick things that are in good shape. It just happened with Novo. We're going to have to look at that next time we do a review. It just took a plunge that we didn't expect, but it's not going to derail us. We're probably going to just adjust the trade and move forward because we already sold puts and calls and we already covered the possibility of it going down. A little bit more than we thought, but we're still covered. But on the whole, incredibly successful. So if you want to be incredibly successful, take a good look at this stuff. This is what we're doing. This is how you be the house and not the gambler. The gamblers are the people we sell our premium to, and we kick their asses all the time, month after month after month, because the odds are completely in our favor. It's like a roulette wheel. We have to be really, really unlucky not to win, and therefore we win on an incredibly consistent basis. All right, so sorry about the technical difficulties. Thank you everybody for coming, and we will do this again next week. And I'm sorry I didn't get to any questions. Let's see, wait. Can you post the link to Anya? You have to ask in chat. I'm not going to do that now. What is your salvage play for Novo? I don't know. On ET, what is the right time and conditions to roll up? Again, I don't know yet, but we will have to take a look at that in chat. Is there a place on PSW to find the actual $700 portfolio on any day of the week? No, we do it in, it's updated in the reviews. It's not updated daily. All right, so that's, you know, we just did it February 3rd. And you can link back to every single other review. But we only up, you know, that goes for all of our portfolios. We update them monthly. You don't need to look at a portfolio every day. You shouldn't look at your own portfolio any day. It's more of a distraction than anything else. It really is. If you set up your trades properly, it's like a garden. You come out once in a while, you put a little water on it, and otherwise you just look at it and go, oh, that looks nice. You know, it's not something you should be over trading. Did you intend NVO in the 700 to be unbalanced? I might have, I might not have, I don't know. Unfortunately, we don't have time to look at it now, but ask me in chat. I'd be happy to go over it. All right, thanks for coming, everybody. I appreciate it. Have a good day.